Good morning, everyone, and thank you for taking some time out of your day to join us here. I am joined by Kent Jackway and Jeff Cothey of ALYZER. My name is Isaiah Dawes. I'm a senior annuity sales representative here at Insurance Agency Marketing Services, and we've got some fantastic information to share with you today that we're super excited to get to about some changes that they've made in their program and some updates. But before we get into all of that, we do have a few items here that we're going to talk about, just why agents love working with us over here at IAMS. If at any time throughout the presentation you have a question, go ahead and pop it in that questions box. You don't necessarily have to wait till the end, but we'll be sure to get all those answered for you. We'll also have 3 poll questions here for you today, so please be sure to participate in those. When you call over to us here at IAMS, at 800-255-5055. Remember, you're always going to get a live person. You'll never have to deal with a dial by name directory, and that's just how we kick off our best-in-class customer service, making sure that we answer that phone with a real person. Maybe it's the person that you're calling in for, but if not, we're going to get you transferred right over and make sure we're getting you taken care of. So jumping right into it, a few reasons why agents love working with us here. We'll start off with our new producer builders. This program is for those of you who are new to IAMS, and these bonuses are available based on your production level within your first 180 days of contracting with us. We do have different levels that you can qualify at, and as you can see inside each level are some really great options for you. We've got incredible business building tools, personal perks for you, and even cash rewards available. If you'd like to know where you stand towards your new producer builder, or if you would like to have a conversation about how to achieve this next level, please just give us a call. Another business builders program that we provide for our agents is our referred producer program. I see a couple advisors on with us today that have already taken advantage of this program, but our business on the wholesale side of the industry is similar to yours in the field in that one of the best leads we can ever obtain is a referral from one of our valued producers. This is why we want to make it worth your while to refer a producer to us. When you do refer someone and they get contracted, we're going to cut you a $50 thank you check, but where the real money comes in is as your referral rights business, where you're going to receive an override on that business. Our ownership team, Charles, Steve, Curtis, and Chris, sign checks for thousands of dollars every quarter for this program. And if you can think of anyone that could benefit from doing business with our team, please just type their information into that questions box, or you can certainly email us with their information. We'll be sure to reach out to them to help them get started. Below the referred producer program is our marketing reimbursement program, which is the most popular one that we offer here at IAMS. For every $100,000 in FIA premium, you're going to get $100 in your marketing reimbursement account. And why this is so popular and lucrative for our advisors here is that we truly do consider this to be your money. So you have the flexibility on what services, when, and who to use these funds with. It is your marketing reimbursement. We don't tell you the vendors that you have to use, but we do recommend vendors that we partner with and leverage reduced rates and preferred service. We also have our creative team here to create a marketing strategy and provide in-house services. So if you'd like to know how much is in your marketing reimbursement account or have a conversation about how to utilize it, just give your sales director a call here at our office and we'd be more than happy to speak with you about that. Next up, our back office support team is another way that we add value to your business. This is a core of IAMS and how Charles Hiring founded IAMS years ago. We want to help the independent advisor work smarter, not harder. So we're going to do that with our great business building tools and resources, and of course, our advanced case designed assistance. We'll assist with life and annuity quotes. We're going to get those illustrations out to you within 24 hours, but really you're probably going to receive it much quicker, usually within the hour. Submission to commission support is handled by our new business teams. Mackenzie heads up the annuity team and Michelle is on the life side. They have fantastic teams who work tirelessly every day to help you get commission quicker. We're also going to scrub applications, submit them on your behalf, and do the administrative tracking and get you updates on those cases as needed. We do this to ensure that you get commissioned as quickly as possible. And this is a service that we provide to all of our valued producers. It's a way that we help you grow your business by keeping you in front of clients while our team handles that back office support for you. Next is our IAMS website. This is a really great tool for our producers to use and another reason to work over here at IAMS. Once you are contracted, you're going to have full access to everything you see on this slide and a whole lot more once you check out our website. So if you haven't registered for it, it's very simple to do so. When we're done with this call, go ahead and create an account. We'd love to see you on there. There are a lot of great resources that are available to you, including illustration tools, online forums, product grids, and news. Industry updates are out there for you as well. Our e-app solutions. So as everyone I'm sure knows, technology is where the industry is going, and Luma is our newest partnership to streamline the application process. Most of our carriers are now on our Luma Firelight E platform, so you can go onto one site to submit your business. Some carriers are going to e-app only for some of their product lines and will also offer extra comp for utilizing the e-app platform. Make sure you ask your sales director before you submit a paper app, because you can earn some extra money by just completing and submitting it through the e-app there. Creative services. So as I mentioned earlier when I was talking about the marketing reimbursement program, we do have a full in-house creative team to help your business. We've got turnkey items available out there for you, and many of our sales resources are white labeled, so we can simply impose your contact information and your business logos onto it. Speaking of logos, if you haven't created a full customized brand for your agency, we can certainly help with that through our agency solution. Name recognition grows your natural market organically. Digital marketing solutions are a very popular topic here around IMES, so we can help you with websites, social media marketing, email marketing, and a lot more. The internet and social media sites are where the overwhelming majority of prospects go to for information, so making sure that you're accessible and represented on those marketing lanes is very beneficial to growing your business. Reach out to one of your sales directors here after this webinar gets over and talk to you about how you can access the IMES creative team, and we can certainly get that ball rolling for you. We do also offer a complimentary marketing analysis for agents looking to explore new sales ideas and programs. Whether you're new to the industry or a seasoned producer, this free assessment can help you boost your business with insights on your website, digital presence, branding, and current marketing activities, as well as recommendations on trusted vendors for everything from lead generation to seminars and social content. Go ahead and reach out to your sales director again to get started with that marketing analysis process. Moving over to IMES Wealth Management. So this is our sister company that we started about 8 years ago. They are an RIA, and basically there's two different sides of this for you. For those of you that have your Series 65, obviously you can just utilize them as your RIA. But for those of you that don't want to get your securities license, or maybe you're towards the end of your career, or just never decided that was something that you wanted to do, you can utilize our Client Direct program. And basically what this is you can refer clients over to our wealth management team to assist with the securities portion of the sale while you handle the insurance side of things. The way we kind of position this to agents is, imagine you're going into a home looking for an annuity sale, and they have about 500,000 in assets that you're looking to do something with, but maybe only 300,000 of that is suitable for an annuity. If you aren't doing something with that other 200,000, you're basically just leaving the door open for another advisor to come in and potentially steal that client for you. So we wanted to have a solution for you with our IMES Wealth Management team, and that's one of the ways that we decided to do this. We actually had one of our advisors a while back that was working with our wealth management team while he was studying for his Series 65, and by the time he passed this exam, he had 8 million in assets under management, and that was all transferred over to him once he got his license there. So we do have a solution for you on all sides of the business so that you can best serve your clients. I'm going to go ahead and launch a poll right now. If you're interested in learning more about IMES Wealth Management, please go ahead and participate in that poll. I'll leave that up here for about 30 seconds or so that you can get your responses in. But I do know that a lot of our top agents have really found this to be extremely beneficial for them in just servicing their clients to on all sides of on their finances. Looks like we're getting some good responses there. I'll leave that up for a few more seconds here. Be sure to get your votes in. All righty. Thank you to those of you who participated. We'll go ahead and close that. Next up, I want to chat a little bit about our life and annuity academies. Um, we host about 4 or 5 of these a year, usually at our home office here in Omaha. We bring out about 30 to 35 agents for a 2-day workshop, and it's not life insurance 101 or annuities 101. So if you're brand new to the industry, this may not be for you. But we do cover a lot of topics, including sales strategies from some of our top producers, marketing strategies with some of our marketing vendor partners. Actually, Kent on the call with us today from ALYZER. He has been out to several of our academy events to present, and always does a great job there. So he can attest just to how powerful some of these events can be. Then we also have presentations from a couple of our carrier partners on their products and service models and those kinds of things. Really, what I believe though is the biggest value add to people from these academies is just being able to network with other producers that are having success in the industry. Rub elbows with them and kind of learn what they're doing that works from them, and kind of get some other ideas from people that are actually out in the field instead of just hearing it from your marketer all the time. So I'm going to launch another poll here for you. If you are interested in more information on our Life and Annuity Academy, we actually will also have our Ascend event coming up here towards the end of the month, which is basically our virtual academy that we host. So it's all online. You don't have to worry about traveling out to Nebraska or anything during the dead of winter. That's also a great way to just kind of kickstart the year, going over industry happenings, strategies, marketing, all that kind of stuff. So you can also, if you respond yes to this, we'll be sure to chat with you about our Ascend event coming up here in a few weeks as well. So be sure to get some of the votes in while that poll is up. Go ahead and leave that rolling for a few more seconds here. Looks like we're getting a few good results there. Alrighty, thank you to those who responded. Go ahead and end that. And I believe from here, yep, perfect. I'm going to go ahead and pass it over to Kent Jackway of ALYZER here. Kent, I will make you a presenter, and the floor is yours. We do still have you muted, by the way. Okay.
Yep, there we go. There we go. So my screen, everybody see my screen okay?
Yep.
All righty. Well, thank you for having me on, Isaiah. This is a great opportunity for us. We love to, any chance we have to not just share our software, but also share the concepts inside of our software and how important they are to the industry right now. Well, with me is Jeff Cothe. He's one of our sales managers, and I just invited him on to just kind of experience, a meeting with an FMO and all, and just kind of share. He'll share a little bit about his background here in a second. The biggest reason I'm on is, guys, we're growing, and I want you to know that it's not just me anymore. We got other people now that you can get questions answered, help the software, help with concepts, all that kind of stuff. Okay, we are going to dive right in and talk about the software. So this is our software. It's ALYZER. I know Isaiah introduced me as ALYZER. That is how we're known. ALYZER is our flagship product. We've been around now for over 7 years, and we literally exist to help you first and foremost with allocations. That's the primary thing we do, whether it's allocating a brand new sale or allocating existing business, which we'll get into here in just a second. So on the screen here, you see there's these four main programs that we're going to touch on here real quick. I'm going to start with ALYZER over here on the right. Again, this is our flagship product. You will use ALYZER for all your allocation needs. So if you are selling, let's just say, let's actually do a different product. Let's do American Equity Asset Shield 10. Now, what I'm going to show you here is a couple things that might be new to a lot of you. We have this drawdown, which I'm going to set at 0 to start, and then retro pricing, I'm going to keep that turned off. And we're going to view the report. On the report, you'll see a nice little blurb about each index, which is important. So, you guys, I know that a lot of people like to stick with the S&P 500, especially now. It's understandable, but you got to understand that they need to really have an idea of what else is in these products, because you might be fitting to them sometime in the future when economic conditions change. And so we have a nice little blurb about each index. And then we have the strategy breakdown. What Indexlyzer is going to do is rank each of the strategies based on their 10-year annual compound historical return. Now, these returns here, you can see them 15, 13, 12, 12, 11. These are incredible returns, believable returns. And I use that word unbelievable as kind of a tactic here, because they are unbelievable. They are not accurate. I know it sounds crazy. I'm showing you my software. I'm telling you it's not accurate. Well, it's not. What is happening here is these returns are based on current model of backtesting. Is being used all over the industry in all the illustrations. It's being used with other software programs. And guys, I'm here to tell you it's just not accurate. Watch what happens when I turn on this retro pricing button. I turn that on and view the report again. We get the same report, but now look what happened to the returns. They all started coming down to earth, is what's happening. Because what changed is the par rates and the cap rates. Because now what we're doing is we're looking at the par rates and cap rates as what they were 10 years ago. Okay, guys, the way that they're doing backtesting now, it's just not logical. Think about it for a second. The way they're doing is they're taking today's rates, par rates, cap rates, spread rates, they're taking today's rates against the last 10 years. Now, if you want a back test, what is a back test? A back test is, well, what happened to somebody that bought this thing 10 years ago? How did they do? What was their return? Well, if you want to know that, today's rates have nothing to do with that process. Nothing at all. They don't impact that at all. You have to know what the rates were back at the beginning of the back test. That will give you a real life look at what happened in these products. So the bottom line is, if you want to show your clients what really happened over the last 10 years, that's where our software really shines. Now, I'm going to break away from the software real quick. I'm going to pull in PowerPoint here and walk you through exactly what retro pricing is and how we came up with it and why it makes sense. To start out, we're going to look at the flow of FIA dollars. Okay, the clients give their money to the insurance company, and the insurance company immediately puts that into some sort of fixed asset, a treasury, a corporate bond, whatever. That's dealer's choice for them. It's up to them. Now, this is an important step, because this is why index annuities are, number one, safe. Number two, not a security, because the client's money is not at risk. It's sitting in the treasury. They take the interest off of that treasury, and that's what ultimately goes into the options market. Every index annuity, IUL, RILA, anything you're selling that's a fixed index product is backed by options. So when you go on that allocation page and you make selections of indexes, the insurance company is going to buy options that back those indexes. They're going to buy call options for the growth and usually put options to hedge. Now, there are other hedging methods out there. I'm not going to get into the weeds that much. Bottom line is the interest. That is the key. The interest is what goes into the options market. It creates what we call the options budget. So that budget pays your commissions, pays for product features, and then what's left goes into the options market. So that interest rate, guys, is of most importance. If you're selling an index annuity when interest rates are like they are today, a lot higher than they were 4 years ago, you're going to have more money to go into the options market. This is the first step in determining what par rates, spread rates, cap rates, what they are. Okay, so how they set those rates starts with what is the interest coming off that fixed asset. And then the next step is Once that interest goes to the options market, before it gets there, there's a fee. If you guys have ever bought options yourself, you know there's an upfront premium to buy the option. Now, that fee is crucial in determining where par rates and cap rates end up, because that fee can be higher or lower every day, even during the day. Now, what moves that fee is volatility. Volatility measures the demand of an index. So think about it with any product you've ever bought. If you buy a product and demand is super high in that product, they're going to raise the price. That's just economics 101. Well, volatility measures the demand of an index. So if volatility is up, doesn't have anything to do with the index being up or the index being down. It's the volatility of it. If it's up, then that fee goes up, and that's going to drive par rates down. And on the reverse, if volatility is down, that means that fee is lower. So now par rates can be higher. The cap rates can be higher. Well, volatility is calculated. They're going to take a standard deviation. That really weird upside down Q is the symbol for standard deviation. Typically a 90-day, it could be a 30, a 60, it could even be a 180. It all depends on the carrier, depends on the index. They're going to multiply that by the square root of time. In this case, 252. That's the average number of days the market is open in the US. That is the formula that's used to calculate volatility. You literally run that formula all the time, all the time, all the time. And its sole purpose is to set the fee for the option. So when you mix together how much interest is coming into the options market, which how much they got to take out of that to pay for that fee, what's left is what you use to calculate your par rates, cap rates, and smooth rates. So if we were an insurance company and we were going to put this Barclays Focus 50 in our annuity, here's how we would price it out. We would say, okay, where are treasury rates today? Today, or at least when I made this PowerPoint, it was 3.767. Okay, there's our options budget. Now we're going to run that calculation on the volatility of the Barclays Focus 50, and we see that today it's right around 3.75, very low volatility. So with the high options budget of 3.767, the really low volatility, so low fee on the option, we can actually get a 180 par rate on this index. And by the way, I know this is an example, but that par rate does exist in a product on this index. So now we have our 180 par. We know what our par rate is. If we're going to back test this, guys, the way the industry is doing it right now, they're taking that 180 get calculated today, and they're putting it up against the last 10 years. And they might say, well, yeah, we want to see what today's rates look like in a real market cycle. Okay, I understand that. But if you're going to put something in a real market cycle, you got to go back and find a time when treasury rates were at 3.767 and volatility was exactly 3.75. You're not going to find that. So basically what I'm saying, guys, is every illustration you've ever looked at, you know they're off, you know it, but this is why. Every other software program out there is doing their back testing this way. It's just dead wrong. It's producing returns that are not achievable. It's putting you in a situation where you're showing sales materials to your clients based on a method that they are not going to have when they buy. So you are showing them one thing and they're buying something completely different. And it has to stop. So that's where we came in and we developed this thing called retro pricing. Retro pricing looks at the same fixed asset. What was the price 10 years ago on the same day? There's our options budget. Then we look at historical volatility. We go back to the same day, run that same calculation 10 years ago, we get our volatility number. So with a much lower options budget and a little bit higher volatility, we see that the actual backtest on this index would be set at 96%, not 180. So we calculate what the par rate was back then, and then we go forward through the last 10 years. How would this thing have really played out? Just like the 180 is only going to affect the future. So our back test is an actual real back test. It's the only one in the industry. So how do we get that exact 96? Okay, so if we're going to set the par at 180 based off of the fixed rate and the volatility, we're going to pay out of that options budget for the product features, commissions, Black-Scholes. What that means, that is the actuarial calculation to determine the cost of the option backing that Barclays Focus 50. So our software then looked at this and it calculates what we call a result. It's kind of our secret sauce. So we calculate that result. Then what we do is we remove the fixed rate and the volatility, lock in all the other pricing structure of the strategy, go back 10 years, and then we use the fixed rates and volatility from 10 years ago, still solving for that 180 par, and we calculate a new result. Then we simply take the results. So if the 2025 result for 180 was 3, back in 2015 with the lower options budget, the higher volatility, it would be a -5. Then we look at what moves in the strategy, in this case, the par rate. So the software then is going to lower that par rate until you get an exact match of the two results. That's how we know exactly that a 180 today would have been a 96 back then. And guys, understand, we have vetted this formula with every single index carrier. Back in March of 24, when I developed it, I literally flew to New York City, sat down face to face with S&P, Barclays, Bank of America, Goldman Sachs, 10 of the biggest index providers in the industry, walked them through this, and every single one of them gave it a thumbs up. Said, this is right. This is the way back testing on our indexes should be done. Now, can they force that on the industry? No, they can't. They have no leg to stand on. That's an NAIC thing. That's a carrier thing. Now, the NAIC has come out and said that they are researching new ways to change how illustrations are done. They are in the process of doing that this year. And yes, they have contacted me. And yes, I have demonstrated this for most of their actuaries and been asked to come and make a formal presentation. So my hope is this ends up in illustration so you can start using them again, because they're going to be closer, a lot closer, if not right on the money of being right. Let's look at how that, we looked at the change already in the software, but I want to show you something here. So this is the Athene Performance Elite 10. Again, back when I created this PowerPoint, there's the returns based on the current method that's being used, using today's rates up against the last 10 years. Look at those returns. Insane. When we switch it to retro pricing, now look at the returns. They again start coming down to earth. There's another feature that we have in our software, because yes, it's great. We got the right starting par rate. That's wonderful. It's way better than we were before. But the problem is we're still not going to see that same par rate for 10 years. The back test. You guys know it. If you've written index annuities for a while, you know that rates do tend to go down year by year. And that's mainly because volatility changes, which changes that fee, which then alters what the par rates and cap rates are. So we have a drawdown feature that we also put in our software. And what it does is it simulates those rate reductions through the 10-year back test. I cannot believe that the illustrations, the other softwares out there, they don't incorporate this in their back tests. We all know it happened. We don't know exactly how it happened, but at least we're simulating this to a point where we're including the fact that rates would have went down. And now look at those returns, guys. I've sold millions of dollars of index annuities. If you do an allocation mix on this, it's going to be right around 7.5%, maybe 7.75%. That's about what my best client got for real. My worst client was probably down around 3.5%. So with our retro pricing, with the drawdown, we are actually illustrating up front rates of return that are very close to even mirroring what returns really are for people. So the bottom line is, what kind of agent are you? Do you want to sell the truth to people? Do you want to show them what they can expect for real when they buy these products? If so, then our software is perfect for you. If you don't care about that, then we're probably not perfect for you. So here's a side-by-side look at the three different options: the current method, the retro, and the retro with the drawdown. Now, I want to draw your eyes to something. I only put the top 10. You guys probably know the Performance Elite 10. It's got 27 options in it. If I put all 27 on there, they'd be so tiny you couldn't see them. So I just put the top 10. So when you see that NTT, that means not top 10. So under the current model, here's the ranking of the strategies. I want you to look at that UBS Innovative Balance. Okay. Second best index based on the current method. Fifth best overall strategy. More than likely would have got some allocation to it. But the reality of it, it wasn't even in the top 10. So it's not necessarily about the numbers, guys. It's about the fact that you're getting the wrong data to make allocation decisions. Look at this. You probably didn't notice this while I was flipping through, but there's the top 10 under the current method. Look at the top 10 under retro pricing. Totally different. Then when you add drawdown, it changes again. So you're not even getting the right information to make decisions. And that's why you're not getting the best performance that you could be getting for your clients, because you've got bad data, plain and simple. You've got bad data. So when we look at our software, you're able to run this type of analysis on every single product. So here again, we switched to just retro pricing, yes, no drawdown. And we've got the numbers down in the 9s and 7s and 6s. Okay, let's put a drawdown. How do we do the drawdown? Well, we give you 3 different options: a 60, a 30, and a 15. How they work is we're going to take the par rate that retro pricing calculates. We're going to give that par rate in the first year of the back test because that's contractually guaranteed when you buy a product for real. And then in years 2 through 10, we're going to reduce that par rate by either 60%, 30%, or 15. Okay, which one do I use? Which one do I use? Get that question all the time. Here's how you do it, guys. You start with the highest one, because this is what's going to cover your, you know what, more. So we put it at a 60 drawdown. We come down and we look at the returns. And we say, ooh, wow, okay, those are barely above a MIGA. Even, only the top 2, the rest of them are pretty low. Now, a 60% drawdown is a massive drawdown. Definitely worst case scenario. So you could show all 3 and show a range, or you could just keep dialing it down until you see numbers that you can sell. Okay, now we're getting into it. Now we got 7s, we got 6s. Let's take a look at it at 15. All right, now we got an 8, we got 6s. Okay, guys, I am totally fine with you using a 15 because we don't know what it is. It's impossible to know what the actual drawdown is, even on the S&P 500 options. It's impossible. You call the carriers, they don't know. I think they do, but they're not going to tell you. And all these other indexes that were created, 1, 2, 3 years ago, they're not going to have data 7, 8, 9 years ago on what their par rates would have changed to. So it's impossible to know, but at least you're simulating. What do we know? What do we know beyond a shadow of a doubt? It wasn't a 0. We know that we had very high volatility during the last 10 years, which means there was going to be rate pullbacks, rate reductions. So you have to simulate that as part of the back test, or you're not going to get accurate information. Now, the last thing that's wrong only with illustrations, all the other software programs, they fix this problem too, just like we do. Our prices on the indexes, all 200 and I think 30 some now that we track, we update those prices every day. Most of your illustration systems do not. So right now, here we are at January 7th. It's going to be pretty close to accurate because they update it in January or sometimes late December, because they're not going to change it for the rest of the year. You're going to be showing January numbers in March, April, May, June, July, the rest of the year. And that in itself is completely inaccurate and probably shouldn't be allowed. There are some carriers, okay, there's like 3. 2 of them actually update every month. 1 carrier actually updates every single day. Kudos to them, they're doing it right. We update every single day. So now you've got the correct back testing. So the rest of the report, first we show you a graph here so the client understands how important it is to get this right. And then we have our diversification optimizer, which is going to give you several options on how to allocate this index annuity and show you the historical combined returns. Guys, I know that page of the app, second hardest page in the whole app, right? Suitability is probably the worst. Then it's the allocations, because you're like, what do I do? What do I do? What do I do? Well, guys, all you do now is you print this page out. You print this page out, put it in front and say, pick which one looks good to you. 2 things just happened. Number 1, you're compliant. Okay, most carriers, if you watch that product training, they're literally going to say, guys, it's not your job as agents to pick these indexes and these strategies. That's the client's job. Why are they doing that? Because they know if litigation ever happens, that's just one more arrow in the quiver of the attorney, of the prosecuting attorney. Okay. So they want the client to make these decisions. What's your job as the agent? Provide the data, provide the research. What we're giving you is the ability to make allocation recommendations based on data, not theory. Guys, if you're using some theory, I don't care if it's not your theory. If you got it from somebody else, as soon as you tell it to a client, that's your theory. And if your theory doesn't hold up, then it's you that's wrong. And that doesn't bode well with clients because we don't want clients mad at you. So use data. You can always fall back on the data. You did your research, you provided the data. If it didn't work out, it didn't work out. We had some crazy markets over the next 10 years. Nothing you can do about that. But at least you use data instead of some theory. And you can also do a custom allocation here if you want to do your own. So that is an option as well. And then at the end, we have an affidavit. Notice how I said earlier how the carriers want the client to make the decision. Well, that's great, but then they don't give you anything to prove it. We do. We give you a page here that you can print out, have the client sign, throw it in their file. It basically says the client represents that they're using the information in this report to assist them in making their own choices pertaining to the allocation of their index annuity. You sign it, date it, throw it in the file. Now you got proof that you did your job and the client did their job, and everything's above board. So that's Indexalyzer, guys. And that's retro pricing and drawdown. Retro pricing and drawdown is going to filter through every one of our programs. So let's take a look at the other programs real quick here. We've got Rankalizer. Rankalizer helps you find what product you want to sell. You can go in here to a new report, select your state, put in your age, put in your term, like we'll look at like 7-year products. You can do multiple reset periods if you want. Throw a drawdown on there. I'm going to throw the biggest one. Make sure it's blue. So gray is off, blue is on retro pricing, and you view your report and you get the top 50 strategies based on what you're sorting there, what you put in your filter. So that's a great tool to find the best performing strategies in the industry based on where you're selling. And then we have Chartalyzer. Chartalyzer is a program that gives you some additional visual aids if you've got a really tough client you're selling against, or if you just want to explain things. And I'm going to use it today to maybe debunk the way you think. So right now, all these vol control indices, these new indices, these fake indices I've heard, they do this and, something to the back testing to make it look so good. And as soon as it goes live, it's crap. I've heard that so many times. Guys, let's look at this. Here's an index, very popular index inside of F&G. Okay, yep, they fabricated this huge run here in the back test to make their numbers look incredible. And then when it goes live, it just turns to crap. Well, let's look at it from a historical point of view. Who was president from 2016 to basically 2020, 2021? Donald Trump, his first term. This is not political, guys. I don't care about that at all. My point is, when he was president in his first term, our markets were humming. Our markets were doing amazing. Well, the chart shows that. And then, boom, COVID hit. Right there it is. Chart shows it. Then what happened after COVID? Biden gets in, inherits an economy that's just a mess because of COVID. Inflation's going crazy. So what does he do? He raises interest rates. He raises interest rates at an unprecedented scale. And what happens when interest rates go up? Well, markets go flat or go down. Shoot. Hank Williams Jr. knew this back in the 80s in a song. Remember that? Interest is up and the stock market's down. Okay. That is a very well-known common thing that happens in the financial service industry. So he raised interest rates that flattened out all these things. And you can look at chart after chart after chart. But you might say, well, wait a minute, Ken. Oh, hold on. That S&P 500, the S&P 500 didn't do that. The S&P 500 kept going up. Yeah, it had its drop for COVID, but it kept going. Well, yes, because of 7 stocks. This is the S&P 500. The top 500 large capital companies in the U.S., it's all their stocks mixed together. You take out just the top 7 out of those 500, that thing's flat or down. Absolutely. So we got 7 stocks that are doing well no matter what's happening in our economy. There's 5 tech stocks, Tesla and Amazon, or they call it the Magnificent Seven. You can Google it. But here's the problem with that. When you get a run like this, you also get extremely high volatility. And the S&P 500 is not volatility controlled. Guys, if you have a 1% movement up in volatility, you can drop a par rate by 10 to 15%. In the S&P 500, it could go up 15% in volatility in 1 year. 1 year. That's why you see, you put people in, and 2 or 3 years later, they're 45 or 50% par rates, now 15. That's why. Yes, this is a great index, and all the NASDAQ ones, because they got those 5 tech stocks in, they look great, but there's also high volatility. So use these with caution. Use them. I'm not saying avoid the S&P, not at all. Get that upfront rate they're giving you, but you've got to monitor it. Each year, you got to go back and see where did we drop that par rate. I've seen statements. I've seen statements where the par rate for the 1 year and the 2 year reset on the S&P were both 15%. 15. Why were they both the same? Usually 2 year par rates are higher than 1 year, whereas they hit the minimums. They hit the guaranteed minimums. Guys, insurance companies now are not making money on some of their index annuities because the S&P gets the most allocation and they're all probably below the minimums. The carrier still has to pay those fees on the options. Okay, they still have to pay those high fees, and they would love to take it below 15, but they can't. So when there's a return, they're actually losing money that year on it. That's why you're seeing suitability regulations get softened. You're seeing way more huge bonus products. The carriers want this stuff off their books, guys. They want you to move this money. They want to get rid of these cases. That's why everything's happening now with replacements and the whole thing. So that's Chartalyzer. You also get a chart. Let me flip it back to a different index here. We'll go back to that CIBC. And you notice, guys, this stuff's really easy to use. I'm just selecting the index, hitting display chart. So we also do this chart where it's the index against what we call the ALYZER average. That's the black line. That's the average of every index we track. So this index I would classify as above average index. Great little chart to show during a sales presentation to really up the trust and help your close. And we show how it does against equities and bonds. This is right where you want an index in an index annuity, right in the middle. This one's a little closer to bonds than I would like, but still not bad. It's still above average, but it's not ranking down near the bonds like some of the indexes like I've seen, like this really famous one, this Mosaic from JP Morgan. That thing is basically a bond. I mean, it just is. And how's it do against the average? Way below average. So this is a great thing to use, especially if you're in a competition situation. All right. If you're working on a prospect, that prospect is seeing other agents or just one other agent, and you find out what product that other agent's pitching to them, come in here and look at the charts. You might find something like this that you could just take in and blow that agent out of the water. So that's Chartalyzer. The last one on the new business page is ALYZER. I'm not going to go into it. It's really simple. You can plug in and pick whatever index annuity you want, plug in a MIGA rate. So the best MIGA rate you know of, the best bond rate you know of, and the best CD rate, and it'll put them all on one chart. It'll show how powerful the index annuity is. Yes, the retro pricing's in there. Yes, drawdown is in there as well. And there's links. If you don't know where to find bond prices or CD prices, there's links in there that'll take you out to websites so you can get current data. So again, all of these programs are for new business. So clients you're meeting for the first time and you're pitching to for the first time. They're all to give you assistance with that entire process. Now, your review business. This is where we really, really shine. ALYZER Pro actually gives you a case management system. You can import all of your cases into ALYZER Pro, and it's going to organize them based on when the next renewal's coming. So right now it's January 7th. So this Linda L case, that's my next renewal coming up. And it's with Athene. So I can click here and see, okay, what are the rules for the renewal? Got that. Okay. So we need to, right now I know we've got this statement. So now we need to look at what's going on with Linda. So we've received the statement. Now we need to go in and update the rates. So we're simply going to click on Linda, go in here, and we're going to take her statement. We're going to walk through. We're going to update all of her rates to get her returns. And Linda, this case here was sold in 2025. So this is a brand new case, no chance of replacing it. So all we want to do is look at the reallocation plan and see if we should make moves inside of Linda's annuity. So it looks like right now she's tracking along at a 3.45, or current 3.58, and we could actually get her up to a 5.02 historical. We're just going to call Linda. No need to go out and see her. Have her fill out the reallocation form and send it in. Done. So I come back out here to my cases, and I look at Linda's status here, and I've updated the rates. So I'm not going to do a review appointment. I'm just going to call her. So allocations are updated. Done. I'm done with Linda. So when we get to 124 of this year, Linda's going to fall to the bottom of the list. And then her status is going to go back to in force. So next year you can walk through the same process. So you literally can just, as you're going through, you got statement received, you can mark the statement received. So you know where you're at with each one of your cases. Now, Linda's got a white background on hers. Steve, the other Steve, Tim, and Joe, they have green backgrounds. There's a reason for that. If it's a white background, that means it's a newer case. You're not going to have a chance to replace it. If it's a green background, you definitely are going to replace it, because that means it was written 4 years ago. That's prior to March of 22. Listen, guys, every index annuity that was written during that time needs to be replaced. Why? Simple. This is going to be your favorite chart. You go out to yahoo.com, go to the finance section, and what I want you to monitor is the 5-year treasury. So I have it saved right here, FBX for 5-year treasury. This is telling me where options budgets are. Okay, so I'm going to look at all data. I'm going to let the chart come in. I'm going to go to all data, and you can see that if we go back to 4 years ago, right about there, where the fixed market was. Guys, we're talking about all-time lows, all-time lows. They had no options budgets back here. So every case 4 years ago, you need to replace it. They're not making money. I can guarantee it. Get their statements and look. I bet they're not even tracking more than 3%. Maybe 3, but definitely not more than 3.5. Because they literally bought it pretty much the worst time. If they bought, especially in this time frame right here, oh my goodness, they're not making money, guys. You need to manage annuities, index annuities. They need to be managed. Okay. On the AUM side, we manage people's accounts. We have active management. I manage. Charge a fee for managing, but I manage your account. We need to manage index annuities now, guys. But you got to have the right tool to do it. You got to have a tool that organizes and helps you not miss anything. So our next one is Steve R, coming up on 2/1. Okay, so the year doesn't matter here for the ranking. It's just the month and the day. So let's look at Steve R's. Now I notice here I've got a little red circle with the number 1. What that means is I have shared this case with my FMO. And I've actually communicated with my FMO about this case, and they've responded back. That's why that little circle's there. So let's go into Stephen R's case here. And I see again another little red dot with the circle and the case notes. So I asked Dylan, hey, can you look at this case for me? And he says, I will take a look. He might send me another note saying, hey, here's what I think we should do about it. So you can literally communicate with your IMS marketer through Review ALYZER Pro. Now I know IMS, they are class to get a hold of. I call them all the time. Every single time I call them, a live person answers. That's precedented in the FMO IMO world. Precedented. This is just another way that you can communicate with your marketer and keep the historical archive of everything you guys talked about. It's right here. Every single case has its own private case notes. So it's literally like a private chat. Now notice I went in and read the note, the little circle's gone. So you'll always know when there's a new note out there that you haven't read yet. So now we're going to take a look at this Stephen R case. Remember, this was green. It was written back in 2019. That means I need to replace this sucker. I'm going to make some money. I am going to make some money on this case. So we go down and we look at all of the rates. We get the rates updated by getting the new rate sheet and pull it in. And to update the rates, you simply just click on it. That's all you have to do. Update the rate, hit the checkbox, done. So you go in and you update all their rates from their current reallocation form. and it calculates instantly the 10-year historical in each one of these options based on the new rates, the new fixed rate, new cap rate, new par rate. Now I see the allocations, I see where all the money is, and you update those as well. You just click on them to update them, guys. So now I see where he's allocated, and the combined allocated return is only 3.45. This guy's doing terrible. He's owned this thing since 2019, not doing good. Now I want to point out, guys, this might not be your client. This may be a prospect you met at some marketing event that you did, and you entered it in, and you can literally mark him as a client or prospect out on the front. I'll show you that when we go back to it. So now what are we going to do with Steven? Well, the first thing is we're going to get Steven in and we're going to talk to him. And we're going to look here. And if you look, okay, fixed rate stayed the same. S&P stayed the same. BMP stayed the same. Morningstar had a rate drop. S&P stayed the same. 8% risk control in the S&P had a rate drop. Janus stayed the same. BMP the same. Morningstar, another rate drop. To be 8%, that's a rate drop because look, guys, that's the spread. So it went up. That's a rate drop. And then the Janus 2-year had a rate drop. Notice that they all didn't have a rate drop. So if you're in that camp that thinks that carriers move these rates just because they're sitting back there saying, oh, where can we make some more profit? Let's lower rates on this one. It's not what's happening, guys. It's the indexes. It's not the carriers. The carriers have very, very little to do with rate drops. It's the indexes, is that volatility moving that fee on the option. That's what moves these rates. So now we can explain that in our explanations tab to the client. No more just saying, oh, why'd your rates go up? Well, it's the economy, it's the markets. No, we're going to look exactly what happened in the bond market from last year to this year, in the treasury market with volatility. Okay, we're going to see exactly what's going on and explain it to the client. Now, when you're doing this explaining, you're not trying to take it to a point where your clients completely understand. That's not the purpose. The purpose is to show the client that you know what you're talking about. It's to build your credibility, your trust, okay, your professionalism. Now we're going to go into the analysis section. This is huge. I have to explain to Steven that he's not making money. He knows that. He sees his statement. What we're going to do with the analysis is show him why. Why are you not making money in this? Why is this index annuity failing you? Back when you bought it, you probably saw an illustration that said 8, 9, 10, maybe 12%. And now you're clicking along at 3.45. What's going on? We're going to look at three things. Fixed rates when they bought, how the indexes have performed, and what has volatility done to impact the renewal rates. Well, we look at the 5-year treasury chart here, 10 years. He bought at a very low point, not the lowest point, but he bought at a very low point on the 5-year treasury. Not even close to where it is today. There's our first clue why Steven's not making money. This is a live case, by the way. This is a real case. Let's look at his index performance. This is going to bring in a chart only where he's allocated. It's not going to bring everyone in, just where he's allocated. Because again, we're trying to find out why he's not making money. Already made a little money here in the first couple years, nothing there, a little bit there, flat there, and up there. This chart looks like he should have been making some money. Why didn't he? Well, if we scroll down to the next section, we see the volatility history. We see a big spike right there. Even though there's a drop there, that spike right there, they would have lowered rates. When the volatility goes down, they don't raise rates. You guys know this. You see statements. What they're doing is they're hedging in each annuity's account. They're hedging in case this happens, this 23 to 24. If there's a major spike in volatility, and it can happen. Guys, even though this is a vol controlled index, that volatility target you see on these indexes, that's just their goal. That's what they're trying to achieve. Doesn't mean they do it every time. Okay. So that spike there, that spike there, that spike there, that guy would have had rate drops all through even these little bit of upward movements in the index. That's why he's not making money. His rates have been getting chop, 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 chop. Now let's look at his Janus. Now this was a 2-year reset. So here to here, 0. There to there, 0. There to there, 0. We don't even have to look at the volatility on this one. The index has not produced a single return since he bought it. And that's terrible. This annuity should have been looked at a long time ago. Well, okay, that's water under the bridge. Let's talk about today. How can we fix this? What can we do? The software will actually give you recommendations. look to reallocate, or if it's 4 years or older, it'll literally tell you upgrade to a new annuity. Based on fixed rates being lower when you initially purchased than they are now, and with the knowledge that the industry has added 88 new indices, 88 new indices since he bought. That 88 number will change based on the year your clients bought, or the clients bought. 88 new indices have been added since he bought this. You need to possibly look at upgrading to a new annuity. All right, let's look at these two recommendations. You don't have to call the client back in, it's already done. So we look and see, okay, we can reallocate. The optimal allocation is only 5.02. To beat that with a MIGA. So this one needs replaced. So that is the best possible historical performance on this current annuity. Not good enough. So let's go to the new annuity. So I've already done it here, so I'm going to act like none of that's there. So this box is going to pop up. You put in the client's current state, because they may have moved. He owned this for 6 years, but in their current age. Then we're going to put in, this is a key, their surrender value. By putting in surrender value, we can know every MVA calculation the old annuity might have, any bonus recapture it might have had. By putting in the value, we pick up those numbers, and it will actually calculate for you here in a second. Put your tax status, select your new product. I'll just leave a Bexus up there. And then you choose your product. I'm going to choose a bonus product because, again, we're only 6 years into this. I'm going to put the highest drawdown possible. Always start there. Turn on retro, add new annuity. Okay, then it's bringing in some really high returns. Some really high returns. So this thing is going to look almost too good. So I'm going to tone it down. I'm going to put 50% there. I'm just going to put 50% here. And now we've got a 12.27. Awesome. So now I go to the comparison and look at this, guys. Look at this. If you can't sell this, go work at a factory, honestly. That red line is where Steven is right now. Okay, click it along to 3.45. We could stay in his current product, reallocate him and get him into that blue line, or we can make the move and get him into the green. So to get to the green, you're basically taking his account balance. There's the surrender charge he's going to pay, bringing over this new surrender value, picking up that big bonus, and then boom, starting at 373. So that's why the green line starts higher than the red. Now, we went through this explanation page to talk about rate drops because we want to set up the ability to talk about the 60% drawdown, because we're literally looking at these two annuities in the same time frame. So you might ask, why is that one so much better? Well, it's the allocations, the indexes that we picked here. Both of these indexes were launched in 2022. He didn't have access to these indexes. Before I know that, I would have went back to ALYZER and it tells me the launch dates. So I see I'm running close to the end of my time, and I want to get to one more thing, guys. But that is pretty much ReviewALYZER. ReviewALYZER could make you so much money, it's not even funny. If you want to have the best year ever, this program will make you a ton of money. Now, another way it can make you money, big time, is marketing. Let me show you this real quick. We have got a program we call it the Phoenix Method, a lead generation program that grows your annuity business by rising underperforming FAs from the ashes. That's why we called it Phoenix. You get with this program a marketing piece, and that marketing piece right now is at a company called MBI. They're a mail house. They're a non-for-profit mail house, so you get a nice discount on postage. So you send out the invitation. You can also get videos from us to put on social media, and then we give you the presentation. We give you the PowerPoint, and all it's going to do is walk through all the different ways index annuities can fail, whether it's when you bought it, management, allocations, whatever. We walk through all the different ways. They follow along with notes, and so they stay engaged. It's only about a 15 to 20-minute presentation. So you bring them out to a workshop, you show them why all the ways index annuities can fail, and then you ask them at the end, now let's talk about your index annuity. Do you want to find out why yours is not doing well? Think about it, guys. If they answered that ad, did you purchase an index annuity prior to March of 2022? We have powerful information for you. They answered that ad. We came to this workshop. They have an index annuity that's not performing. You're going to replace it. Plain and simple. Because you're going to offer them a free analysis at the end of the workshop. And then all you're going to do is go pick up their statement, bring it back, throw it into ReviewALYZER Pro, bring them in, walk them through everything I just walked through. Boom, sale made. Hey guys, think about that. a workshop program. You do a Social Security workshop. All right, you get 30 people show up, 10 of them sign up for an appointment. You give them the list of everything to bring in, and then you bring it in, you do the plan. You got about 3 appointments where you might close them. With this system, you will close them because you're going to basically replace that underperforming annuity. Then after that, I can go for all the rest of their money. It just makes, I mean, this is a very targeted marketing approach. Again, you have to have a Reviewalizer Pro to make it work because that's the program that's going to do the analysis. So when you mix all this together, you got a powerful, very focused, very sales driven marketing program. Again, this is the advertisement piece. Did you purchase an index annuity prior to March 22? If so, we have valuable information for you about why your index annuity is not performing well. You owe it to yourself to attend this free workshop. And again, we don't want to be Fisher Investments here. We literally say on there, an index annuity is a powerful part of your retirement plan. If it's not managed properly, it can have severe impact on your retirement success. Have you checked your statement lately? And then they get into the other part of it. And it just talks about all the reasons why the next annuities can fail and why they need to come to this workshop. So guys, you get this. There's no cost on top of the cost for our software program. This is a free add-on that we just give you to enhance your business and utilize Reviewalizer Pro and utilize it in a marketing situation. So to get signed up, you simply go out to www or just indexalyzer.com, indexalyzer.com/IAMS. That's going to take you to this page right here. As soon as it comes up, there we go. You get a major discount being with IAMS, guys. We normally charge $250 a month for everything. Everything is all included into one. You get knocked down to $100 a month, guys. That means if Reviewalizer Pro finds you one case in the next 12 months of only $20,000 of premium, you're making money. That's it. All right, Isaiah, I'm pretty much done. Is there any questions or anything you want to add?
Awesome. Yeah, thanks, Kent. I'm going to go ahead and launch our final poll here real quick. If you're interested in getting more information or potentially signing up for ALYZER, feel free to respond to that poll there that I've got going. While we're doing that, we did have some questions come in here. Actually, just one. It was, what about North American Secure Horizon for just growth and no fees? Like into the laddering strategy for the S&P Prism. That was the question there.
Okay, yeah. Well, the bottom line is we have every product in our system. So yes, you could go in and check out that product and it's going to give you the allocation information. The Prism, the Secure Ride, they're both in there. They're both in there. And I know they have those preset options. All you have to do is go in and do a custom allocation and put those preset options in, and you can see how each one of those standard allocations performed. I think that's what the question was geared towards, don't you think, Isaiah?
Yeah, I think that.
Those preset. Yeah, that's why we put the custom allocation in there, so you can do them.
Perfect. Yeah, it looks like that was about the only one that we had. So I will go ahead and take this screen back real quick here. Share my screen while that poll is still running. Still some time to get some responses in there, but please feel free to connect with us on social media. We'd love to see you connect with us on there. We're always posting updates on what we're doing here at IAMS, as well as industry news and those kind of things. So that's a great way to just kind of stay in the loop. Okay. Oh, I guess I clicked through it there. But if you have any questions, feel free to reach out to us here at 800-255-5055. We'd be happy to chat with you more about ALYZER and talk to you about how you can start getting signed up for that program and utilizing it. Alrighty, I'll go ahead and end this poll. Thank you so much, everyone, for attending today. Thank you, Kent, for taking some time.
No problem.
Really appreciate it, and hope to talk to you all soon.